going to have to pony up more money, which is going to be a problem considering how broke most Americans are and how heavily indebted they are. But trade is not going to completely grind to a halt, which is what the markets were bracing for when the tariffs were 145%, and it was 125% going in the other direction. So the markets had this relief rally. But I think investors are missing out on the big picture here because the tariffs aren't really the problem. I mean, they were a problem, but they're not the problem. The real problem is the trend of de-dollarization and the dollar's status as the world's reserve currency in jeopardy, because we have certainly brought the dollar status to the forefront, I think, in a bigger way than Biden did with the Russia sanction. I mean, that was certainly a slap in the face, an alarm bell, warning to the rest of the world. Hey, you got to get out of dollar, because that is, your vulnerability. To the extent that you're dependent on the dollar, you leave yourself open to U.S. retaliation in the form of a sanction. And so that sent the message that was received loud and clear: hold dollars at your own peril. But I think what Donald Trump has done has really, taken it up quite a few notches by threatening all kinds of tariffs on countries. And, to the extent that you allow yourself to export so much to the United States without importing, and you have these huge trade surpluses, and you therefore are obligated to accumulate dollar assets on foreign holder of our treasuries rather than domestic holder, who obviously, can vote and would not be too happy about, not getting their money back. But the Chinese can't vote in our elections. And so I think that this trend is now accelerating to get out of the dollar, and not just the dollar, but dollar denominated assets. So bonds, stocks, and in fact, the stock market has recovered, all of its losses, but not the bond market. On Liberation Day, the yield on a 10-year treasury was under 4%. Today, it's almost 4.5%. In fact, yesterday, it closed at 4.54. We had a bit of a rally today in the treasury market. And so the yields are back below 4.5%, but they're not that far below. We're at 4.44 on a 10-year. So hardly any of the loss has been recovered. Same thing for the 30-year. 30-year was below 4.5, and now it's almost 5. It closed at 4.9. It was, I think, 4.97 yesterday. And so the relief rally in the stock market did not spill over into the bond market. And that is a huge vulnerability, not just for the U.S. economy, but for the stock market rally. Because if the bond market really rolls over, if we break decisively above 4.5 in the yield on the 10-year, which is breaking down. Remember, that's when Trump initially paused the first round of tariffs, not the Chinese pause, but the initial pause. It was because he said the bond market was getting a bit yippy. Well, it's yippy yappy, right? It's still, doing what it was doing. It's just not as quick. It was a sharp collapse back then, but now it's back at the same level. And I think it's getting ready for another sharp collapse. I think the yield on a 10-year treasury can move from 4.5 to 5 very, very quickly. And that's going to be a big problem, especially when Donald Trump has made it clear in his entire administration that one of their main goals is to bring down interest rates. Well, interest rates are going up. And even if Powell caves and cuts short-term interest rates, long-term interest rates are going to rise. After all, they rose after the first few cuts. Why should they not rise if he cuts more? I think the only thing that could temporarily stop the rise in long-term rates is going to be a return to QE.
Let's cut the fluff. Tariffs hit right away, but you don't feel it right away. There's a lag, and we're in that lag right now. Companies knew the tariffs were coming, so what did they do? They front-loaded inventory. They stocked up on sneakers, electronics, furniture, anything and everything before the new taxes kicked in. That's why you've seen trade deficits explode in recent months. The numbers are off the charts. We imported record amounts of goods not because the economy was booming, but because the people running the supply chains are smarter than the politicians imposing the tariffs. They said, let's get this stuff in now, while it's still legal robbery and not actual theft. But here's the punchline. Once that inventory runs out, it's game over. The shelves won't be empty, but what's on them will come with price tags that make your eyes water. And if you think inflation has already peaked, buckle up, because that was just the appetizer. The main course is about to be served, and it's going to taste like cardboard dipped in gasoline. Now, of course, some consumers will see what's coming and panic buy. You'll see people rushing to the store to buy extra sneakers, maybe 3 or 4 pairs. Not because they want to start a collection, but because they know they're not going to be able to afford new ones in 6 months. That's what inflation does. It changes behavior. It pulls forward demand. It distorts reality. It makes hoarding look rational and saving look insane. Retailers will get a sugar high from that initial rush. Wall Street will misread it. They'll say, "See? Consumer spending is strong." But what they won't understand is that it's not strength, it's desperation. Because when those shelves are restocked, everything is going to be priced under the new regime. And that regime is one where the US is no longer exporting inflation. It's absorbing it. For decades, we got away with printing dollars and shipping them overseas in exchange for cheap goods. That's over. We used to export inflation and import deflation. Now we're going to import inflation and export political dysfunction. And if you think I'm exaggerating, look at the trade data. Look at the treasury market. Look at the gold price. This is the end of an era. For years, the inflation we created didn't show up in Main Street prices. It showed up in asset prices, stocks, bonds, real estate. Why? Because foreigners took those printed dollars and recycled them into our markets. They bought treasuries, bought equities, even bought condos in Manhattan. That's what kept rates low and the stock market high. But now the flow is reversing. Foreigners are no longer recycling those dollars. They're dumping treasuries, they're avoiding US stocks, and they're buying gold. And when that capital flow reverses, all of that inflation we used to offload onto the rest of the world comes home. You want to know why rents are surging? Why insurance costs are up double digits? Why food prices keep rising even though the Fed says inflation is falling? It's because the system is breaking down. The supply chain isn't the only thing that's fractured. The confidence chain is too. Meanwhile, politicians are patting themselves on the back for slowing inflation. But what they're really doing is driving a stake through the heart of the American consumer. Because the solution they're offering is more government, more regulation, more taxes, more tariffs. Let me ask you something. When has taxing people more ever made them richer? When has restricting trade ever made goods cheaper? Tariffs are a tax on the consumer. Full stop. Anyone who tells you different is either lying or running for office. Now I know what some of you are thinking. Peter, aren't we protecting American industry? No, we're not. We're protecting inefficient industries that can't compete globally. And in doing so, we're punishing every single American who relies on affordable goods and services to survive. You want to build a strong manufacturing base? Great. Start by slashing regulations, lowering corporate taxes, and fixing our energy policy. Not by punishing Americans for buying what they need. But this isn't just about economics. It's about politics. And this is where it gets ugly. Trump launched the tariff war thinking he was going to out-negotiate the world, that he was going to bring jobs back, boost the economy, and crush China. What he actually did was plant the seeds for a devastating stagflationary crisis and hand the Democrats a political weapon wrapped in populist rage. The Republicans had a chance. The Democrats were a mess. They had no message, no leadership, no base unity. But now, Trump just gave them a villain, someone they can blame when the economy goes off a cliff. And make no mistake, it will go off a cliff. Because once the inflation shows up in force, the Fed will be powerless to stop it. Rate hikes won't work, QT won't work, and the people will want someone to blame. The narrative will be simple. Trump inherited a strong economy and destroyed it. It doesn't matter whether it's true. It only matters that it feels true to the average voter struggling to buy groceries, pay rent, or fill up the gas tank. By the time the midterms roll around, Republicans will be bleeding seats. The House, gone. The Senate, flipped. And this won't just be an electoral setback, it'll be a total policy collapse. Because what comes next is not fiscal discipline or economic reform, it's MMT, UBI, Green New Boondoggles, and more government control over every aspect of your life. You think the last few years were bad? You haven't seen anything yet. And all of this stems from one root problem. We have been living beyond our means for decades, and the bill has finally come due. We built an economy on consumption without production, on debt without discipline, on politics without principle. And now the foundations are crumbling, and we're arguing about who gets to rearrange the furniture. It's pathetic. But I'm not just here to rant. I'm here to wake you up. because what's coming is going to make 2008 look like a warm-up act.
The specter of this Bitcoin conference is also probably causing some buying of Bitcoin, because people probably expect that the conference will generate a lot of publicity, a lot of hype. And so people like to buy Bitcoin into that hype so they can sell it. And it's normally a buy the rumor, sell the fact. So maybe we'll get a big dump in Bitcoin, either during or maybe just before the conference. I mean, people may try to, get ahead of it. And they may not even wait for the news to start selling. There could be a sell-off even before the conference begins. But my point was, I think it's significant that the risk appetite is waning. And you can see that, most pronouncedly in Bitcoin, which is the riskiest of all the risk assets. And so if people's appetite for risk is diminishing, you would see it there. Now, of course, while the stock market was rallying and, gold pulled back. Gold had about a 10% pullback. Gold almost got above 3,500. And this morning, it was well below 3,200. In fact, at one point overnight, gold was down about 20 or 30 bucks. And that was following about a $70 decline yesterday in gold. In fact, I was watching gold in the morning and it was down about $15 or $20. And then over about a 2 or 3 minute period, it got clobbered by like another 50 bucks. No news, nothing happened. Somebody just decided to dump, a shitload of gold, at 6 a.m., 6:30, whatever the time was. And the price just got killed. And it pretty much stayed down all day. And then it went down a little bit more last night before it had a big reversal. Gold was up about $60 today. So about $80, $90 off of its low. And so I think today marked the bottom of the gold pullback. So I think it's over. And, gold's now, 3,200 and change. Let me see where it is now, 32.35. And I think the bottom is in. Now, it's possible we can go a little bit lower, but I don't think so. I think 3,000 is the new 2,000. If you remember when gold was above 2,000 initially, and I said 2,000 is the floor, you got to buy it. Well, now 3,000 is the floor. You got to buy it. It's, we're not that far above the floor at 3,200. You're not that far above 3,000. If we make another 50% move, which I think we could easily do, which is what we did from 2 to 3,000, that takes from 3,000 to 4,500. Well, we're a hell of a lot closer to 3,000 than 4,500. So you should buy it. But of course, the best thing I think to buy of the metals is silver, because silver is still around $32 an ounce, $32.70. When gold was at 2,000, silver was about 30. And I remember when silver first got above 30, I said, okay, 30 to silver is 2,000 to gold. And I was right in that silver didn't go back below 30, just like gold didn't go back below 2,000. But then gold went way up and silver didn't. You had a 50% rise in the price of gold, but barely a 10% rise in the price of silver.
So let's keep going. We've laid out the groundwork. Tariffs are going to crush the consumer. Inflation is going to come roaring back with a vengeance. And politicians from both parties are too busy pointing fingers to admit that they lit the fuse. But what's coming next? That's what should really keep you up at night. The American economy isn't just headed into a downturn, it's headed into a structural collapse. The model is broken. We've been pretending that we could consume without producing, borrow without saving, and print without consequences. And for a while it seemed to work, because we exported our problems. We shipped our inflation abroad by running massive trade deficits. We gave the rest of the world our dollars, and they gave us their goods. It was a great deal for us. We got TVs, cars, iPhones, sneakers, all while sending IOUs. But now it's reversing. Now the rest of the world is saying, no thanks. They don't want our dollars. They don't want our debt. They want real stuff, like commodities, real estate, gold, not promises. This is the fatal wound. When the US can no longer export inflation, it has to live with it. And the economy we've built isn't designed to do that. It can't. We've gutted our industrial base. We've crushed small business with regulation. We've flooded the country with easy money and easy credit, and that's about to blow up in our faces. Now what happens when inflation stays elevated and the Fed can't raise rates high enough to stop it? That's when confidence evaporates. That's when foreign buyers finally say, we're done. They dump treasuries. They dump dollars and they move to hard assets. And here's where it gets interesting, because this collapse isn't going to be global. Not this time. Let me be clear. I do not believe the world is heading into a synchronized global recession. In fact, many countries are going to do just fine, maybe even better than fine. Why? Because their factories still work. Their trade relationships are shifting. Their demand is increasingly domestic or regional. You think Vietnam, Indonesia, Brazil, India, they're all going down with the US economy? Number. They're going to sell fewer goods to Americans, sure, but they're also going to sell more to each other. They're going to build new trade routes, new currency arrangements, new pricing mechanisms. And while America burns, the world will adjust. It's already happening. BRICS is talking about launching a new trade settlement system backed by gold or commodities. Saudi Arabia is accepting yuan for oil. Iran is using barter for fuel. Countries are building cross-border payment systems outside of SWIFT. The dollar is losing its monopoly. Now imagine what happens when the dollar truly loses its reserve status. That's the ball game. That's when the US can't fund its deficits. That's when rates spike. That's when the Fed is forced back into QE. Only this time, the inflation it creates can't be exported. You get a collapse in the bond market. You get a currency crisis. You get stagflation on steroids. And you get political chaos. Now let's talk about treasuries, because nobody in the mainstream media seems to understand what's coming here. Everyone's still pretending like US debt is the safest asset in the world, the gold standard of collateral, the risk-free rate. Risk-free? Give me a break. There's nothing safe about lending money to a government that's running $2 trillion deficits in peacetime, in a growing economy, while spending $1 trillion a year on interest alone. There's nothing safe about rolling over $26 trillion in debt in 4 years with no foreign buyers left. There's nothing risk-free about being paid back in devalued currency. This is the same delusion we saw in 2007. Remember subprime? Remember how everyone said it was contained, that there was no risk, that the market had priced it in? And remember how those bonds were trading above par until they weren't? Treasuries are the new subprime. That's not hyperbole. That's math. And just like in 2008, nobody sees the risk because it's not in the models, because it's unthinkable. But just like 2008, it's coming. And when the market finally wakes up, bond prices are going to crash, yields are going to spike, and the Fed will be cornered. They'll have to choose between defending the bond market and saving the currency. And guess what? They'll choose the bond market. They'll print. They'll bail. They'll flood the system with liquidity and destroy what little purchasing power the dollar has left. And what will gold be doing while all this happens? Going vertical. The central banks already know. They've been buying gold at record pace, not ETFs, not futures. Real physical bullion at $3,000, at $3,200, at any price. Because they understand that when the dollar falls, gold doesn't just rise, it reclaims its throne. Because gold isn't a commodity. It's not an investment. It's money. The only money that doesn't depend on someone else's liability. The only money you can't print, you can't default on, and you can't sanction. You want a real safe haven. You want a real hedge. You want real wealth insurance? Buy gold, hold it, store it securely, and ignore the noise. And while you're at it, don't forget silver. Silver is the most mispriced asset in the world right now. The gold-silver ratio is still above 80-1, and that is completely unsustainable. Historically, it should be 15-1. Even in recent modern cycles, it's reverted to 30-1 or 40-1-1. That tells me one thing. Silver is going to outperform gold in the next leg of this crisis. It's not just poor man's gold, it's smart man's gold. Because it's a monetary metal and an industrial metal. It benefits from monetary collapse and industrial demand. And in a world trying to electrify everything and decarbonize industry, silver demand is going to explode. So while the Wall Street bros are still chasing tech stocks and the Reddit crowd is playing hot potato with meme coins, the smart money is quietly hoarding the metals that have stood the test of time. And you should too. Now look, I get it. This is all heavy. Nobody wants to hear that the greatest financial empire in history is falling apart, that the dollar is dying, that the American middle class is being sacrificed to save Wall Street and Washington. But this isn't doom and gloom for the sake of it. It's reality. And the sooner you confront it, the sooner you can protect yourself, because the collapse is already in motion. The tariffs are just the trigger. The deeper disease is systemic: debt, delusion, and the destruction of honest money. And if you want to survive what's coming, you need to stop listening to the people who caused the problem and start preparing like your future depends on it, because it does.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.